All right, you guys. So we're gonna continue our conversation today on life insurance. And so we conceptually talked about IUL and VUL a little bit last time, and of course we've spent some time on term and living benefits and all of that. And what I want to do over the next couple of trainings here is get deeper into IUL, and then pivot to VUL and kind of start from the ground up, help you guys understand where this product fits, the whole term versus permanent concept a little bit, which we touched on last week, and really just improve your understanding of the product, how it's built, what are the different moving parts in it, and then how to illustrate it. And then once I think you understand the IUL, the pivot to the VUL will be quite easy. The example I've used my whole career is they're basically the same car. We're just swapping out engines. But the product here I'm going to use to show you guys is nationwide. Not that they're our only provider or the best in every scenario, but they've become kind of my preferred provider for a couple of reasons. But it sets up well for this training because I really like their illustration software. And with a couple clicks of a button, you can take a case and move it to an IUL, move it to a VUL, move it to some different IULs they have without re-inputting all the information. And so this becomes a great kind of engine that we can train on for you guys that in time for all of you guys that are just life licensed, you can do the IUL we're going to get deep into today. And depending on how far we get here in our time, we might spill over into part two next week. And then once you add a securities license to your repertoire, then you can get into the VUL business. And I think both are great products. And one thing I'll double down on towards the end of all this is I don't think you could definitively say a VUL is better than an IUL or vice versa. They're just different. There's pros and cons to both. They're different scenarios where one might, they're even though I can write both, there's times I write an IUL and there's times I write a VUL. And we'll talk through those as we go through this. But let me just set the stage with this. There's two things that we want to really do throughout this training. One is I want to teach you guys how these products work because I firmly believe in you've got to be an expert in these products inside and out because that's going to help your confidence. It's going to help your ability to explain it. It's going to just help your ability to field questions and objections. All those intangible things. One of my favorite quotes I refer to all the time by Albert Einstein is if you can't explain something simply, you don't understand it. And I think that rings no truer than something like a permanent life insurance policy, because you could take something like this and make it sound really complicated and really confusing and kind of suspect, or you can make it sound very straightforward. And in both cases, deliver, a competent explanation of compliance of how everything goes. And so we're going to go through deep on your understanding of the product. And the second thing we're going to do is we're going to really train on how do you explain this product. And we're probably going to do both simultaneously, just back and forth, because I think that's a totally different skill set. The customer service centers at these life insurance companies are full of people that understand how these products work. They know all the fees, they know how to run illustrations, they know how to pull an in-force policy up and look at it and figure out what's going on. But sitting down at a kitchen table or on a Zoom or in an office with a prospect and bringing in that teaching element and that sales element and that gathering of trust element, that's a whole different skill set overlaid on top of understanding the product. And so you got to have both, and I want to kind of cover both as we go. But before we get into the illustration and kind of going through the product, which we're going to do today, I just want to set the stage with this: is the IUL is probably the most versatile financial product that exists in financial planning. There's a lot of great products out there, from mutual funds to annuities and all sorts of different kinds of annuities and different kinds of life insurance policies and Roth IRAs and simple IRAs. And, we could go on and on about all different kinds of products. But the IUL, one of the things that I've heard over many years is it's the Swiss Army knife of financial products, because there are 4 or 5 key attributes to an IUL that make it really appealing to somebody that might want to purchase one. And one of the, from a sales standpoint or from a production standpoint, one thing that's really important is, understanding which of those tools or which of those elements of the product is most resonates with your prospect. So for instance, in all my years with all my clients, I've sold IULs to people that primarily wanted a permanent death benefit. That was their number one goal. And then some of the other aspects or attributes of the product were kind of secondary or tertiary. I've other clients that their primary goal was tax-free accumulation of investment assets inside the policy. That was their primary hot button. I have other clients that they look at the IUL and they love the idea of the indexed options where they have exposure to the stock market, but none of the downside of the market. And so they love the consistency and the low volatility of that product. I've had other cases, I've written a policy where, we kind of looked at the benefit side of it as a pool of money. And so it was not only a permanent death benefit for their spouse or children, but it was also a pool of long-term care money that could be used down the road that was really benefited to them. And yet I've had other clients, probably less so, but where their primary hot button business owners was asset protection. In the state of Ohio, assets within a life insurance policy are heavily protected from creditors, from lawsuits primarily. So I've got some doctor clients, some business owner clients that they just love the aspect of that creditor protection. It's kind of like having money in a protected trust. And it's much more protected than mutual funds or IRA accounts or college funds or any of those kind of things. And believe it or not, there's some intangibles beyond those things, but the five I just listed are probably the biggest five. And of course, with many prospects, it's a combination of 2, 3, 4 of those that we're hitting. And so again, understanding your prospect and then simultaneously understanding the product and really figuring out, okay, for this product, for this prospect, what's like the number 1 or 2 hot buttons that they have that this IUL would address, that will determine whether or not you close business. And there's a lot of IULs that get presented across our company and across our industry that the clients just don't move forward with because they're just left confused, unsure, or, just, I don't know if it's the right fit. Let me talk to my uncle. Let me talk to my accountant about it. Let me talk to my lawyer friends, see what they think. And anytime somebody is left unclear, they're going to be searching for clarity somewhere. And so if it's not going to come from you, it's going to come from the internet or a trusted friend or a family member or you name it. And the more that they're going to sources other than you, the less likely it is that you're going to do business. So I think many of us have probably experienced that. So let's get into what this looks like. So the way I'm going to do this today is I'm logged into Nationwide, and most of you, or if not all of you, should have access to this if you at least have a life license. And so once you're logged into the site, we'll do kind of a site training another time. But I've got favorites here, and I'm going to click on the Nationwide Life Illustrator, and I'm going to click Launch on Web. And can somebody give me a thumbs up? Is my screen updating as I click through to like the new screen? Okay. So let's go through here. So there's a lot we can get into on this illustration. And so I want to spend some time here because everything we cover on this will be virtually the exact same if you're doing a VUL with Nationwide as well. So, and I think once you understand this, you can then look at somebody else, another carrier, and figure it out. So I'm going to go on here. I'm going to just go to a saved case I have. And I've got a sample client. All right, so we're going to go through this case here. So I just kind of put this together here this morning. And so the first thing I'm doing is under the actual product, Nationwide has a lot of different options. So if you can sort by IUL up here, if I wanted to look for a VUL, I would click that button. But these are all of their IUL products. Now, some of these are basically, I mean, they're out-of-date products, or like these last two on here. I think they have these on here for illustrations for maybe Enforce or something. But the one I focus on primarily is this UL Accumulator 2. It's not worth getting into why that. It's basically their newest, best price product, all their newest features, and so that's the one we're going to focus on. So I'm going to select that. Excuse me. And so what I've done here is, actually I was doing age 30 here. So under insure, you would put your client name, male, female. And then I always put a birth date. If I have a birth date, I'm just going to plug in age 30 as just a starting point here. Risk class, I never, ever show something beyond preferred, meaning I never illustrate a preferred plus. Even if I think this guy is super healthy and doesn't smoke and never seen a doctor, you name it, I never want to box myself in a corner where at best it comes back what I've illustrated, and at worst I have to explain why he didn't get the best rating out there. I'd rather illustrate a preferred, not make a big deal about it, and then go in and say, hey, by the way, we actually got you approved at preferred plus, which congratulations, very few of our clients get that, and I've got a little bit more latitude, and you'll find it doesn't make a huge difference on an IUL. So we could talk more about rate classes another time. Tax bracket, you can kind of ignore that. It doesn't really factor in. So then you go down here to face amount and premium. So for today's policy, we're just doing a 30-year-old client, nothing too exotic or too high net worth or high income. So I'm doing a $250,000 death benefit. And if you want to change any of these numbers, by the way you do it is that the drop down is going to give you some solve functions. You just want to click this little calendar looking thing over here. Maybe it's supposed to be a calculator, but you just punch in the death benefit, and then you can put either years or you can put age. Okay, so if you put just a number, it's going to be policy year. If you want to, and then max just means forever. It means, I think it runs to like age 120. But let's just say, for instance, I wanted to illustrate, hey, we're going to start with a $250,000 policy, but in 5 years, we're going to increase it to 500,000. Not that I necessarily suggest doing that, but just so you guys understand how that works, I'd go in here and I could change this to like policy year 5. And then I could say, hey, let's double it in 5 years. And that would be policy year 6 through max is what I would write. Or alternatively, I could say policy year 1 through A 35, which would be age 35. And then I could put A 36 here, so you can play around with that. But that's pretty much all the manual programming you need to know here. So I'm just going to get rid of this because we're just doing 250,000 the whole time. All right. I'm going to go through a lot of the main stuff today. If we went into every nook and cranny, I'd get off on all kinds of wormholes and tangents, and this would be a 7-part series. So for now, let's just leave it at guideline premium test. Death benefit option. This is a big one. Your primary options are increasing or level. Okay, and I'm going to give you my opinion on some of these things. Most of it is not going to be fact because you can do different things. All these software tools have different solve functions, and if you spend time with wholesalers, they love to show you the solve functions because it just kind of looks cooler. I've always operated under the simpler you keep something, the better. But fundamentally, and this is really important, an increasing death benefit means your client's going to get the cash value they build up with in the policy plus the death benefit at death, or more specifically, their beneficiary is going to get that. So if we start with a $250,000 death benefit, in 10 years from now, there's 20,000 of cash value, and you'll see this on the ledger. The death benefit would actually be 270. It would be the 250 plus the 20,000 of cash value. As a general rule, most of the policies I write are increasing, and we'll get more into that as we get into illustrations. Because two factors. One is most people don't want to lose that cash value. And so a level death benefit would be a $250,000 policy. And then, so that stays level, as time goes on. And as that cash value grows, that gap you have basically gets absorbed by the cash value. So there are times when a level policy makes more sense. Typically with older clients where, long-term costs are an issue. because the two advantages there's two advantages to increasing and one disadvantage. Okay. The number one advantage to increasing is you're going to have a policy that grows over time. So I think there's some inflation protection, especially on a younger client. I think that also they're going to get their, they're going to get their death benefit plus their cash value. And then another benefit is in an increasing policy, you can actually fund more. You can put the IRS lets you put more money into the policy. The only disadvantage of increasing, and you'll see this on the illustration, is if we leave this as an increasing death benefit forever, that means that the client's going to pay for $250,000 of coverage every year for the rest of their life. Not going to make a big difference the next 10, 20, even 25 or 30 years possibly. But as they start getting into their 60s and 70s and 80s, paying $250,000 of coverage is going to just be an enormous internal cost. And so we'll talk about how we address that here in a bit. But almost all of my policies, especially with younger people, start out as increasing because it just gives them a lot more inflation protection, a lot more funding flexibility, and all of that. So we'll circle back on that when we get through the illustration. And then scheduled premium here, $400 a month is what I just plugged in. So one of the first things I do, and I should pause here, once I get the base death benefit plugged in and the insured date of birth, one of the first things I do is I go up here and you want to hit this calculate button. And when you hit this button, this is going to give you like a first little glimpse of what this policy looks like. So what'll come up here, and I'm going to focus just for right now down this bottom left-hand corner where it says illustration snapshot. It's going to show me the $250,000 death benefit. I just plugged in 400 just to kind of put a starting point there. But let's go through what some of these numbers means, because this will impact what we input. So if we look at, first of all, target premium. So there's two answers to what target premium is, okay? And this is an important training piece. What target premium technically is that's the amount of premium that your commission is based off of, okay? So some carriers have, if you run a $250,000 death benefit at Transamerica and Pac Life and Nationwide, you're going to get 3 different target premiums, okay? That's an internal number the company assigns. And what you'll find is some carriers have a lower target premium, but pay a higher commission rate on that amount. Other carriers have a higher target premium, but pay a lower commission rate. What you'll find is that it nets out pretty darn close. Because you'll see that Transamerica, for instance, pays 125% on their target premium, and Nationwide pays like 105%. But Transamerica's target premiums are often lower. So when you net it all out, you end up at a very similar point. It's a competitive business, and so I think ultimately that's a good thing for everybody. But what I explain that to a client is I say the target premium is the minimum goal amount that Nationwide thinks you should put into this policy to make this policy perform as intended. Okay. So let's compare and contrast that a bit, because if you go down to the bottom here, it says minimum monthly premium $63. So if you do $63 times 12, that only ends up being $756 a year. So Nationwide's saying technically your 30-year-old client could put in $756 a year and have permanent death benefit protection. And that guarantee, basically that premium would cover all of the fees. They'd have a tiny amount going to cash value, but it would make the death benefit basically guaranteed to stay in force for at least 20 years. I've never sold a policy on the minimum in my life. It's akin to just, buying a Ferrari and putting cheap gas in it. It's not gonna, your engine's gonna fall apart, and it's just not gonna work, right? So you need to put enough money in to build up cash value so that later on your policy is essentially a paid up status. So all things we're going to get to. But as a reference point, sometimes I'll show a client, the versatility of this, say, hey, if we ever had to drop down, we have a lot of flexibility to drop this $400 payment down to 63. Almost every prospect you're going to meet in the middle market is going to ask you the same question. What if it's some version of, hey, what if something comes up in our life and we can't make this $400 a month payment? What are our options? And one of the first things I show them is, well, hey, if if a pinch, you wanted to drop down to 63, we could. And that's usually really reassuring to people. But I tell them the target premium is the minimum I'd want them putting into a policy. And my internal goal that I've had for almost every policy I've written my whole career is I want clients putting at least 20% over target. That's just, I want policies to perform well. I want my clients to be happy with these 5, 10, 15 years later, and I have many that are. And the better you fund a policy, the better it's going to perform. The more flexibility your client has when, all of a sudden a recession comes, they lose a job, or the wife stops working, or this happens or that happens, and they need to make a change. You've got some options because you've got a surplus of cash in there. And so it's just been a better way of operating my business. And then you have
Gotcha.
this, I'm not going to cover all of these numbers because most of them aren't super relevant, but this guideline annual premium, 10,304, that's the max the IRS allows you to put into the policy every year. Okay. So essentially you have a pretty wide range here. You can put up to as little as $756, as much as $10,304, or anything in between. And so you have a lot of versatility. And I've got some clients that max fund IULs to the very limit. I've got some that are just right around target. Like I said, none of them are just minimum. And then a host of ones in between. So let me just pause right there. Any questions on what we've covered so far, whether it's the funding limits or kind of what we've done so far on the illustration?
Yeah, I had one. So is this minimum monthly in the left-hand side the same as Nationwide's conditional credit endorsement
It is
premium?
not. It is
Okay.
not. Yeah, you have to put more premium for that, which we'll get to. The minimum
When you say
monthly is
perform,
for the death benefit no lapse guarantee, which for Nationwide, it's a 20-year guarantee or until the client turns age 65, whichever happens first. So in other words, if the client's 50, they're only going to get 15 years of a guarantee.
when you
Ryan,
say
Sean, do you had a
perform,
question?
yeah, when you say perform, what does that mean?
That we're going to get to that on terms of the interest
Okay.
you earn and all that. So yeah, stay tuned on that. So let's move on. Again, we're gonna bounce back and forth, and I think and one of my homework assignments for all of you guys is get on with Nationwide this week if you're not already, and spend time on this. You guys, I spent countless hours my first couple years in business just doing mock illustrations, and I'd call customer service at that stage of my life. It was primarily the company called Western Reserve Life that we were working with. And I'd call the WRL and they'd walk me through the illustration, and I'd play with, okay, what happens if I change this? What happens if I change that? And I got so fluid with like, okay, if I change this, I know what's going to happen over here. And if I change this setting, I know what's going to happen over there. And I got really comfortable with bounce around the software. And I just, the more I understood all the moving parts of the policy, that's where my confidence grew immensely about, hey, if I design this correctly, it's going to be amazing for this client. Guys, this is like think of prescription drugs as tools. You guys, the right prescription drug could save one patient and literally kill another in an extreme example, right? So does that mean you could definitively say XYZ prescription is good or bad? No, I mean, that would be a ridiculous statement. That's why one of the many reasons, anytime you hear somebody on social media or online or whatever say IULs or cash value life insurance is terrible, you need to dismiss those people immediately, because anybody that would make a blanket statement like that, I mean, I wouldn't even say the stock market is for everybody, right? And I'm a huge advocate of that, but not if you can't handle the volatility and you're at a stage of life where you don't need that risk. And so it's about understanding products and what's the right fit. And so we're going to spend a lot of time the next couple of weeks bouncing back and forth on purpose, because I want to see you guys. I want you guys to see, okay, when I go back to the report, then here's what it looks like. Let's go back to the inputs. Let's see what it looks like. And so To continue on that, I'm going to go now back to, I'm going to click this button here, case design, to get us back to where we were. So here we are. I inputted four. So basically I just picked a premium kind of in the midpoint roughly of that target premium and that max premium. I mean, a little bit lower towards the lower end there, but premium mode monthly here. And then I'm not putting in a lump sum. I'm not, again, we're going to skip over some of these features that just to cover like the main parts, and then we can go back and get detailed. So now let's go to interest rate and income. So for now, what we're going to do is we're going to focus on, this is a good place to basically talk about how this earns a rate of return. So to your question, Ryan Schwann's, I need to come up with a one-name nickname for you and Ryan Wagner. I don't know, something better than Schwann's and Wagner. So stay tuned on that. But how it performs will be based on what kind of interest we earn based on what strategy we select. So fundamentally on an IUL, one thing that all IULs are going to be the same on is they all have a guarantee not to lose money in a down market. In exchange for that, you're going to have some limitation on the upside of the market, right? Now, what those percentages are and what indexes those are going to vary based on carrier to carrier and how we design it. But I'm going to click on this link right here. It says click here to get info on index strategies. Seems like a good place to click. So here are their current rates on their IUL. And so let's start with a couple things. Let's start with the S&P 500. We've talked about what that index is and the RILA and Goldman Sachs a bit. So that's a good benchmark to start with. So what Nationwide is saying is you have an upside of 10.25% and you have a floor of 0. Okay. So basically every year you're going to earn the first 10.5% of the S&P, nothing more, but nothing less than 0. And if you look at the long-term history of that, the historical average of that is 6.94%. And it'll tell us somewhere how far that goes back. It looks like I believe that's a 30-year. All our strategies are using 30 years historical data. So over the last 30 years, that's average 6.94. But there's a formula that all the companies have to follow that isn't worth getting into that basically reduces that a bit because it backtests over a longer period of time. So it'll predetermine what the max illustrator rate is of 6.42. That's my Nationwide wholesaler right now. I should pick up and tell him I'm doing his job for him. So 6.42% is what this is going to illustrate at. But then you look over here, they have this multi-index monthly average. Now it doesn't show it on this page, and I don't want to just bounce around too much. But what that is this is what I prefer to use with Nationwide. It's a blend of the S&P 500, the Dow Jones, and the NASDAQ. So the three primary US large cap indexes that exist. And it's an average of those three returns, but there's two things that are really, really cool about it. Number one, because you're averaging three indexes together, the way Nationwide prices that out, they can offer you a substantially higher cap rate. So the cap rate is 13% versus 10.25. That's a big number. But number two, the way they can do these options, and some of the carriers do this, is they're going to look at the end of every year, and they're going to look at the return of each index. And whichever index returned the highest number gets a 50% weighting towards that calculation of interest earned. The number 2 index gets a 30% weighting. The number 3 index gets a 20% weighting. So if this year the NASDAQ does the best, and then the S&P, and then the Dow, you're going to get 50% of the NASDAQ's performance, 30% of the S&P, 20% of the Dow. If next year the NASDAQ underperforms and the Dow does the best, then you get 50% of that. So I think it's a smoother return, a better chance of capturing where the market is currently moving. And obviously with the higher cap rate, in my opinion, there's really no reason why you shouldn't put your clients 100% in that multi-index average when working with Nationwide. And if you look at the historical average, you can see it's 7.43 versus 6.94, you know, you're picking up an extra 0.5% a year, which you guys, that's a huge difference over 40, 50 years in an illustration. You know, you go back and play with those numbers, it's a huge difference. So they illustrate the same, you know, based on some of those guidelines that the carriers have to follow, but in real life, that multi-index is the way to go. And then what's the last thing that's really interesting about Nationwide that I like on the IUL, makes it super competitive, is you can choose a high cap option. So they work the same. So let's stick with that multi-index average. Now, instead of a 13% cap, you have a 25% cap, which is enormous. But you pay a fee for that, which is 1%. So, you know, the thing I look for is, am I better off after the fee or not? And of course, there's going to be years where you're not. If the market loses money and you pay that 1% fee, you're going to lose 1%. But over average time, when you're capturing those bigger years, you can see the historical average is 8.14%. All right, I'm sorry, no, 9.24%. So if you take 9.24, and I don't know if they're illustrating this before or after the fee, but let's assume they're showing this before the fee. Then if your client's at 8.24 after the fee, you know, that's almost 1% higher than the non-high cap. And so for the Nationwide IULs I use, I'm almost entirely using that high cap, or I'm using some high cap and some regular, depending on how fee sensitive the client is. But to maybe give you guys a comparison, this is a similar idea to when we compared like a no fee Prudential RILA to the fee version of Allianz. If the client pays that 1.25% fee, they get higher earning potential. And I think for most people, they come out ahead, but that's kind of a distinction there. So any questions on this piece of it before we move on? So the last thing I'll cover on this page before we go back to the illustration is it's important to understand mechanically how these IULs work. So they all kind of work the same. You're going to have most clients fund a policy monthly. In fact, if that's what they should do. And so you're going to have what's called 12 segments, okay? So you're going to have a January segment, a February segment, a March segment, so on and so forth. And so if we start a policy in January and we start putting in, it doesn't matter, let's say we're doing this, $400 a month. Over the course of the first year, we're dropping $400 in every segment, right? So at the end of the year, we're going to have 12 buckets of money, 12 segments, if you will, all with $400 in it. You guys follow that? Well, the only way we can determine the interest is we need to see what the rate of change is on the index from, you know, from year to year. So if we start this policy January 1st, 2024, then Nationwide is going to look at the S&P 500, just use one index for simplicity, January 1st, 2025. So that $400 is going to sit just earning like nothing. It's just going to sit there idle in that January segment all year long. And then come next January, they're going to look at the rate of change of the S&P 500. Let's just, for argument's sake, let's say we're in this S&P point to point 10.25% cap. Forget the high value, forget the multi-index, all that. Let's say the S&P grows 15%. Well, in that case, your client would get 10.25, and that would be accredited interest into that January segment. So now that January segment might have $432 in it, whatever the math is, okay? And then that next January, they put in another $400 of premium. So now that bucket's got the $400 from year one, the interest from year one, and then the $400 from year two. You guys follow how that works? And then same thing's going to happen in February. Same thing's going to happen in March. Same thing's going to happen in April. Let's say May rolls around and the market crashes. Well, now we're going to look at, okay, well, May 2025, the S&P is actually lower than it was May 2024. It's negative 7%, let's say. Well, in that example, your client earns nothing. So that May bucket would have the $400 from year one and then the $400 year two, but no interest credit for that segment. So that's how these things work. And then, so if you have a policy 10 years in with, $150,000 in it, you're going to find there's going to be, 10 grand in the January segment and 12 grand in the February segment and so on and so forth. They're going to bounce around a little bit based on the interest that gets credited every month. But that's essentially how these work. So does that make sense, you guys? Any questions on that? That might have been a lot to cover just verbally, but I'm sure there's an illustration somewhere we can find that'll show that. We good? All right, so we're running up. We got about 10 minutes left here, so we'll get to a good stopping point. The only additional thing to add to that is I just covered how the segments credit interest and grow every year, but then fees are going to come out every month. So January's cost of insurance comes out of January bucket and February's cost. So that's the accounting of every segment. But an IUL ultimately is made up of 12 segments. So let's go back here to where we were. And so back to this illustration, the traditional indexes are going to illustrate at 6.42. The high cap is going to illustrate at 7.49. Really important distinction here. We just showed you how the historical is better than that. But part of the regulations is called AG 49. That'll be on your final exam. Is they didn't want agents to be able to show, they wanted all IULs to illustrate about the same. They didn't want people promising too good of a return. And so you'll notice that you can choose high cap, but if you illustrate 7.49 and then the 1% fee gets deducted, you're at 6.49. You're virtually at the same place as illustrating the traditional. So that's a big change that's been made, because you had a lot of artificially lofty looking IUL illustrations out there where they looked better than a VUL, but with no risk. It was almost too good to be true. And so the last thing to cover on this page is I would use for nationwide the multi-index, set it and forget it and be done. It's like a self-rebalancing index with all three of the main indexes. I would never touch, ever, anything that says volatility control index. I would never touch that in an annuity. I would never touch that in a life insurance policy. We could do a whole training on this that I won't go down that rabbit hole on today, but these are marketing gimmicks, okay? So they aren't real numbers. There's no historical record on them. There's a lot of moving parts that you can't see. There's no transparency. Other than that, they're great. And those four things. But those are marketing gimmicks that we don't want to get into. So let's keep it simple. Let's stick with the mainline indexes. And one thing you guys are going to find is, and this might be a good place to pause here in our training, I want you to take a step back and think about, in all the training we've done, one of the consistent threads is some of these primary US-based indexes. So, how I design Goldman Sachs accounts are primarily using S&P 500 and NASDAQ indexes with a few other things. When I invest clients in a RILA, I'm primarily using, S&P and NASDAQ indexes with maybe some Russell or a few other things. When I'm using a variable annuity with Jackson and I'm picking sub-accounts for performance, but also low cost, I'm primarily allocating to S&P, NASDAQ, and maybe some small and mid cap indexes. And here we are again in life insurance, again using core primary indexes. And so you're going to find a continuity to your business here. So how we're participating in all these indexes, we're hedging risk, depending on the product we're looking for. With Goldman, we're getting dividends on all those things. With Jackson, we're getting dividends. With RILAs, we're not getting dividends. Here, again, we're not getting dividends because we're just tracking the price movement of the index. But I want to connect those dots and have you guys see that thread as we move through this training, that the more you start kind of getting your mind around the financial world, it can be really complex if we make it, or we can keep it pretty simple. And anyways, I think that's one thing that makes this really duplicatable as we move forward. So what we're going to do next time is we're going to get back into this illustration, and we're going to kind of start projecting this. I wouldn't possibly have time to get to that today, but we're going to go through riders you can add, and we're going to go through different output designs. And so next week, we're going to take the same inputs that we already have. I have this case saved. And we're going to launch right into showing you the illustration. And we're going to start pulling a lot of things from that illustration, different columns, different moving parts. And you're going to kind of see this come to life. But my challenge for you guys between this week and next week, and by the way, these trainings are only relevant if you put the work in, right? If you only learn how to play golf the 1 hour a week you're with your instructor, and you don't ever go to the range, and you don't ever work on your swing, you're just not going to get better at golf really at all, or at any kind of a reasonable rate. You got to put the time in the range. And you guys, this is no different. Our range time is in your computer, running illustrations, getting with your trainer, getting involved in cases you're working on, and you start connecting these dots. So make sure you get on Nationwide software. If you have trouble with that, if you're stuck on that, reach out to Alec. If you call me on that, I'm just gonna invite you to call Alec and give you his cell phone number, or reach out to Ryan Wagner. But basically, we'll get you set up with Nationwide and start playing with it. And then after next week's training, you're gonna have a lot more visibility on options and things to get into. But as we're wrapping up, any other final comments, questions on what we've covered so far today?
With that, I'll offer up like jumping on a Zoom tomorrow, just a time if people are interested in wanting to tinker around with the numbers. I'd be happy to sit on and share my screen and we can walk through how things change. So if you're interested in that, shoot me a message. And if time works for a couple of us, I'd be happy to do that. And I can record if necessary too.
Sounds awesome. Well, hey, we appreciate you guys. Hey, let's keep our head down. Let's keep working hard. If I don't talk to you, have an amazing Labor Day weekend. Hopefully you guys have some time to chill and do some fun stuff. And we'll pick this up next Tuesday and keep things rolling. So appreciate you all, and we'll be talking soon.